everyone. Under orders from Nick, we'll get started right away. My name is John Gaffney. I'm a corporate partner at Gibson, Dunn, and I'm pleased to be back with what's really an excellent panel. Let me quickly go down. The backgrounds are written in the book. You can go through them, but just to quickly introduce who we have here today. Robert Perri is here from Axia. Axia, excuse me. Robert has the particular advantage. He's recently moved over from the an operating role side, now over to the analyst side, maybe to get to drier ground. Herman, Hildan at Clarksons Platou, and Ben Nolan from Stifel. You know, an advantage of being the last panel of the day is you get to I've seen all the earlier panels, and I think is a chance to try to sum up a number of the concepts that we had today. We certainly had a lot on the dry bulk market and certainly a lot on private equity or the lack thereof in the market these days. Maybe though, before we get into sort of the sector analysis, maybe a little bit just from the demand side and a little bit of investor sentiment. I think as the comments were earlier today, you know, certainly the market for shipping stocks in general is down, although there are some bright spots and maybe some opportunities in different sectors that we'll get into. But maybe get your impression, or the panel's impression, just on this sentiment from the investors you're speaking to, many of which who have already taken losses in the segment. How do you get them back in? And if not, are there other, given the state of where the sector is, are there other investors out there who maybe didn't have a chance to participate, or luckily didn't participate in the last round, who may be interested? Maybe just going down the line. Please, Robert.
Sure. I guess I get to be the easier one since I'm first. I mean, investor sentiment is pretty dismal right now. It's pretty easy to say that most investors have bigger problems than shipping. And at this point, the guys that actually thought they got it right in tankers lost money, so they're pissed and they sold. Basically, they're selling. Guys in dry who got burned are also not happy. And it's there's most of the guys are looking at it and they don't really, they look at the space and they say that I'm just too small for me to deal with at this stage. I'll leave it at that to let you guys.
I heard a joke a few weeks back from a client. He said that shipping is like the ocean. It's cold, it's rough, and if you stay in it too long, you die. So that's I think that summarizes quite well the sentiment in the shipping space. As touched upon in previous panels, the massive redemptions you have for energy and emerging market funds are, at least in my opinion, driving the valuations you have now. And for some companies, it's actually a pretty good position to be in. For example, take the tanker market. You have fantastic rates, you have a fairly decent outlook, and you have a company that's priced as if we were in 2013. So you can obviously, you're kind of getting a bonus to create some additional value by buying back shares on top of calling the market right. So I think, you know, on the dry side, obviously things are quite different. You asked about the demand side. Last year we had negative demand for dry bulk for the first time since 1998/99. And obviously the commodity collapse has not only resulted in investors pulling out money of the sector, but also on the more fundamental side, drawdown of inventories. I think if you look at, just take the four key commodities on dry bulk, if you take iron ore, coal, grain and steel, global consumption of those four commodities is 14 billion tons. Global total dry bulk trade is 3.7 to 3.9, depending on whether you include coastal trade or not. So I think there's lots of potential for growth in the dry sector, but I think we have to remind ourselves that it's a cyclical business. And another quote, as Keynes once said, apparently after doing a lot of leveraged trades, he said the market can stay rational for longer than you can stay solvent. I think it's extremely important that companies, and I think hopefully that will be the future of this industry going forward as well, that in order to be in the shipping space on a long-term basis, you need to have a capital structure that can, call it, sail in different types of markets, not only the good markets, but also the bad markets.
Yeah, I think the biggest issue for shipping equities, well, first of all, I think you can universally say that really nothing has been good. And irrespective of the cash flows or the dividends or any other measure that you could possibly use to value any type of equity, or frankly, even fixed income instruments, everything has been performed poorly. That tells you that what we're dealing with is not really a fundamental rational decision. That doesn't mean it's wrong, though. And to Herman's point, I think what we have seen is redemptions and people selling or being forced to sell. The real challenge in this market is a lack of new eyeballs. People, incremental investors who weren't already invested in this space, don't care to invest in this space. And there's several reasons for that. Number one, shipping is volatile, and most of the people who aren't already in it are generalists, and the degree of volatility, the size of the investments are generally not sufficient to pull them in. The other aspect of it is, I think, in this market, as opposed to a number of other times throughout the cycle, shipping is not the only place to find value. The high yield market is blown out. Energy investments are blown out, and in some of those cases, in energy in particular, the path to a recovery is much more obvious, particularly if you're somewhere stacked higher in the capital structure. So if you want to invest in an improving energy market, within there are E&P companies who might be a quarter of the valuation, but are still bigger than the entire scope of the shipping space with just one company. So I think that's the biggest challenge. There is tons of value in the market, and it's the easiest thing in the world to make a case that, look how undervalued these shipping equities are, they should be valued better. But the bigger problem is, look at how undervalued everything else is, and everything should be valued better. And there's a lot of fundamental dislocations, and shipping is just not big enough or important enough to drive that incremental investment. And I think the only resolution is time. It's just going to take a little time for the public markets to work themselves out.
Ben, maybe just picking up on that point and starting with you again, there was comment earlier today about the importance of, in this part of the cycle, shipping companies communicating more with its investor base. And maybe if you can comment on that, both to shore up the investors it has, communicating them about where they stand, strategy, and go forward, and then will that help drive that incremental investor in any way? Is that?
I think, well, first of all, if you're going to be a public company, I think the onus is on you to communicate with the stakeholders. It's part of the obligation. You need to do it because otherwise you might as well be private. And certainly the better that you are at that, the more confidence investors are going to have in what you have to say and what you're trying to accomplish. That said, I think that if a company is in this market, I don't know that a company can really differentiate itself by being especially proactive. Not that you shouldn't do it, but a management company could go on the road meeting every possible investor that they could find, and they probably will find some incremental buyers. The challenge is everything is so cheap that nothing in this market is really, it's going to be a challenge for there to be a dislocation of value. So if everything is cheap, there's only so far you can push it. And it doesn't matter how much you're out there talking to people. I think the big advantage in terms of being proactive with your investor base is that longer term, you'll get a better relative valuation. So in this market, you're still probably never going to feel like you're fairly valued, but if you can create a premium brand, there is some value to that.
Anything to follow up on that?
I mean, I think in today's environment, you can really cherry pick the best operators, they're all priced at a very good level. You can pick whatever you want. And if you don't tick all the boxes, it means that you will, on a relative basis, always be relatively worse priced. So it's a choice you have to make as a company. If you follow up with your partners or investors in a proper manner and create trust, most likely over time you will have an edge over the companies that doesn't. It's a pretty simple thing, I think.
No, just to touch on what Herman just said, I mean, trust is the important thing. I mean, when you talk to investors or when the companies talk to investors, they have to be honest with what they're seeing in the market. I mean, nobody wants to hear, dry bulk's going to turn around next quarter, rates are going to pick up. You might get away with it once, but you're not going to get away with it a lot. They do appreciate, I think, when you go see them in the bad markets and you tell them, look, it's really bad, but this is what we're doing to help, and you need to tell them what you plan on doing and then actually do it, as you said. I mean, to build the trust with the investors, to get in front of them, to explain what you're doing, and then go back, next quarter, say, hey, this is what we said we were going to do last time. Now this is what we're doing, and by the way, this is what we plan on doing going forward. I mean, it does help, but as they both mentioned, I mean, in today's market where everything's undervalued, maybe it helps you get a little bit more of a premium, but it's not going to, automatically put you at some huge difference from the rest of the investor base or the rest of the universe.
Just like a very interesting example, take Nordic American Tankers. They barely have a conference call ever. But everyone knows that he's focused on Suezmaxes, he's focused on low debt, and he will pay dividends. He actually doesn't really have to walk around and tell everyone that the rates are going up or down. So I think the trust you build with the financial markets is the predictability. And whether that means having 500 roadshows a year or whether that means having 0, I think that it's extremely important that your investors and that your partners can understand how you will behave and that you're predictable. If you're not, you will get a discount.
And you follow through on your strategy. But maybe just turning to the sectors, and we've heard a lot on dry bulk, so if we can, I'm going to leave that to the end if we have time, and maybe spend some time on the others. I think Nick put up a chart earlier today that showed really the dislocation in the tanker segment vis-a-vis operating results and the market vis-a-vis pricing. Maybe if I could ask each of you to talk just a little bit about the fundamentals you see in the market, any expectations or changes you expect over the next 6 to 12 months that may drive a change in how they're performing, and then if you like, call out companies that you think are doing a good job and expect to do well over the next 12 to 18 months. Please.
I mean, I think everyone can see it in the tanker space. I mean, you see, even OPEC now, they came out and they said they're going to cap, but they capped at what, the highest level that they've been running at in a long time. There's a huge surplus of oil out there. Oil prices have gotten beaten up. There's an underlying demand there. And the oversupply of oil isn't huge. I mean, it's about 1.5 million barrels a day. It's not crazy numbers, but you've seen this, you've seen on the tanker side that rates are strong. Maybe now it's a little bit weaker than people were hoping going into February. But the market overall, I mean, the fundamentals, even if you look at the order book, at least for the next 6 to 9 months, it looks like it's going to be a good market. I think the problem is that everyone agrees that 15 was almost a perfect storm, that, might be the best market we've seen in a long time. I don't know that people think 16 is going to be as good, but that doesn't mean it's going to be bad either. But I think investors, because they see the peak, they feel like it's a bit over. Even though, from our view, at least for the next 12 to 18 months, we think the tanker stocks are going to do well. Crude going forward for the next, 9 to 12 months, let's say, products look to have like a very strong second half of the year. Going into 17, products are probably even looking even better than crude. And it looks like it's going to be an interesting time. But, as you said, investors are sort of just worried about what's going on now and what might happen if the world collapses. From a stock point of view, I mean, you look at guys, I mean, like Euronav, and it's just it's in a perfect position to do well. I mean, guys like Chacos, they're doing very, very well. This company's trading at an extremely discount to NAV. They have some new builds, but they have them fully chartered, so there's really little risk there on the chartering side. And even, for better or for worse, guys like Generate that have a huge order book, as they take delivery of these ships, they should be maybe not back to NAV, but even if it goes from 50% of NAV to 60 to 70% of NAV, there's something to be made there. I mean, that's basically good.
Yeah, I mean, I think you touched on something very important, and that's obviously how OPEC will behave in the coming, going forward. And personally, and I'm not an analyst on the oil market, right? Obviously, it's essential in terms of what happens with the tanker market. I think back in 1973, after the Yom Kippur War, we had the oil price going through the roof, and oil demand turned negative. And OPEC, actually Saudi Arabia, cut production from no more than 10 million barrels per day down to 3.6 by the mid-80s, until they actually couldn't do it anymore. So they gave up, oil price collapsed, and things recovered again. I think it's a very similar dilemma that they were confronting in, call it the November meeting in November 27, 2014. Do we cut production? Or do we accept that we've kept oil prices so high that we've gotten competition from US onshore production? And they decided to let the oil market decide the price, since they are the low-cost producer, which I think that's an extremely important inflection point for the tanker market, the strategy that OPEC seems to be applying now. And you mentioned OPEC capping production. It was actually Russia and Saudi agreeing to not increase output. But then you have Iran and you have Iraq, which is likely to ramp up production as well. But at the end of the day, it's politicians, and they're even more challenging to forecast than tanker stocks. So things can change, and I think that's why it's extremely important to, when you invest, try to focus on risk-reward. Pick the companies that have a strong balance sheet, that even if the market, for some reason, surprises on the downside, you don't end up in a situation where you have 90% leverage and hit the wall within 6 to 12 months, which is what we've seen in the dry space. And then when it comes to, and actually, quite nice to see that you do have quite a few good alternatives. You mentioned Sakos, you mentioned Euronav, DHT is also on there. And I told this another joke, a few years back. It's like, if you get the Victoria's Secrets in front of you and ask to choose one, why choose one? Why not take all of them if you can? So that's what I would do. I would buy a bit of DHC and a bit of Euronav and a bit of Chacos, and those are all companies that will do very well. Yeah.
It's tough to follow.
Distracted figure.
I tend to, first of all, on the oil side, I think there are a lot of very lucky tanker companies. I will say 2 years ago, when talking to people that were ordering VLCCs, not one person 2 years ago said, well, I'm ordering this because I think OPEC is going to act irrationally. That was the luck. Now, you can look at the order book and say it's a little underdelivered or whatever, and so there's a chance that it can work. But ultimately, this really, we were talking about earlier this morning, the perfect storm with respect to capital. This was the perfect storm with respect to the oil tanker market. But that's the problem. When I go meet with investors, they say, okay, fine, the oil market's doing well. These companies are generating good cash flow, but it's because the market's acting irrationally. I don't know that I want to align myself with that irrational behavior because it's subject to change at any time. I would rather go into an industry where the fundamentals are more transparent and more controllable. And again, I don't know that doesn't mean that the tanker market won't work. I think it probably will. It's at valuations that appear to be pretty obvious. But that is a fundamental challenge for investors. A company can come out and say, look, isn't this great all day long? But at the end of the day, they have no control over whether or not it stays that way. And it probably will. But it may not, and that's enough to spook an awful lot of investors that I talk to on a daily basis. I think within the equity universe where you can get investors more on board is in situations where there's a catalyst or a potential catalyst. Take, for example, a company like Golar and their FLNG, and there's a lot of doubters, and that stock has been pretty poor. But the fact is, just 2 weeks ago, when Schlumberger said that they were going to participate with Golar, the share price was up 50%. It's a catalyst, and there's not really a catalyst in the crude market until the energy market starts to settle and people can get a little bit more comfortable that hey, this price is irrational. Catalysts are probably the only avenue to outperformance, in my opinion.
I would like to comment on that. I think the major problem that we have today is that capital is way too short term. It's the shipping industry, which is cyclical. If you try to make a positive return absolutely every day, it's just a matter of time before you lose your money. And I think personally, I favor I definitely like Golar, and you're well aware of that. But I think the problem today is capital being way too short term, and I'm not sure if the short term capital is if shipping is the right place for short term capital.
I think that's the problem. Everybody that's interested in investing in shipping outside of the people in this room are short-term investors. By and large, at the moment, with just a few exceptions, they're all hedge funds, and by definition, almost all hedge funds are short-term capital. So if you can't convince them that they can make a return in the short term, then they're not going to do it. And the guys that do have long-term capital, they're the ones that are concerned that the companies they're investing in can't control their own destiny, unless they have a fantastic balance sheet or what have you. And I think at the moment, that's the most important thing a company can do, is solidify their balance sheet, because when things do get rational, they're going to be in the best position to come out of it. But it's the nature of the beast. Certainly in this environment, there's just long-term capital is not interested. It is what it is outside of private equity, which the guys talked about earlier. But I think in terms of incremental equity investments and frankly even debt investments, this market today is focused on the near term, and like it or not, that's the reality.
Maybe stepping away from tankers and talking a little bit about containers. We haven't spoke that much today. Probably next to dry bulk, they've been hit pretty hard with the slowdown in world trade, difficulties in China. What are your thoughts in this sector? Are there opportunities? Is there a role for consolidation in the container sector? Robert, you want to?
Well, when I look at the container sector, I actually been joking that it's probably quietly as bad, if not worse, than dry bulk. The owners the liner operators continually order bigger ships, larger ships. It's massively oversupplied. There was cascading to an extent, but now basically anything below 11,000 TEU is earning less than 10,000 a day. And a lot of these ships are extremely expensive. They were extremely expensively built. And, these guys are starting to lose money several years in a row. I mean, I remember when we were doing box ships, I think there was only 1 year that a liner operator lost money, and that was 2009. Now it's several years in a row. I mean, some of them have, maybe they've broken even in one of these years, maybe they've made a little bit of money, but everyone's hurting in container shipping. And I start to get worried that the liner operators at some point, I mean, you see it now with HMM, they're going around, they're trying to cut the charters on, granted their entire book. And you might start seeing some other liner operators that start running into issues as well. I mean, people talk about the fact that it's never happened in containers. People don't really cut rates in containers, but it does happen. There's some renegotiation. Maybe it's not just a cut. Maybe they don't stop paying you, but it becomes an issue. And I think it's going to stay that way for a while. I mean, you see it now. It's just, if you look at the industry, I think it's just massively oversupplied. These bigger vessels, people forget when you order 18,000 TEU vessels, they're not profitable if they're not, 75%, 80% utilized with containers. And, that's where we are now, that these ships are just trying to maintain, some sort of capacity and to make some sort of money. Talking about the fact consolidation, I mean, you see the liner operators now consolidating. I mean, I'll let you guys touch on that a little bit more, but I mean, you see it. People are trying to consolidate it, at least at the liner level. Trying to rationalize the routes and things like that now. So they're trying, but they're still losing a lot of money. I mean, hell, it's like what less than $600 to ship a container from China to Europe now, something like this. I mean, it's crazy.
If you go on the demand side on containers, what you've seen historically, the rule of thumb has been volume growth is 2 times GDP growth, and then it fell to 1.4 times in 2014 and 0.9 times last year. I think eventually and as you point out, the operators are focusing on cutting costs, and that's, from an owner perspective, that's not a good position to be in, particularly not when the guy on the other side of the table is as big and strong as they are. But I think at least what we view is that from an investment perspective, the best way to play the container industry is actually Maersk, who's a fantastic company and the leader in the space, a cost leader, and that's kind of how we focus on container at the moment.
Well, I have 2 things. First of all, with respect to the demand side and trade, I heard an interview the other day with, I think it was the chief strategy officer of Axia, the big furniture company, and he said that globally, well, within the United States and Europe in particular, we've reached what he called peak stuff, where, like peak oil, you've reached a plateau where people just don't need any more stuff anymore. And I think that, to Herman's point, I think that's why we've begun to see this decoupling from GDP to container volumes, because containers are stuff, or they're filled with stuff. And in the developing markets, people just aren't buying more stuff. Where that becomes a big challenge is where in the past number of years where we have seen growth is in a lot of the emerging economies. You've seen a healthy north-south trade from the Far East to Latin America, Africa, or some of these places. The big issue there is what happens when those economies turn south. I mean, look at what's happening in the Brazilian economy, and effectively all of those developing economies are resource-based economies where they have oil or iron ore or some other commodity which by and large has just been decimated. Your final growth driver for the container space in these emerging markets is all of a sudden turned off at the same time we've reached this peak stuff environment. And I think that the days of consistent 5 to 8% container shipping demand are gone. That is a thing of the past. That said, it's still will ultimately be a cyclical business. And the other aspect, I think, from a lessor perspective, that I think is interesting is a lot of the lessors have really benefited from an unsustainably low cost of capital, where you can go out and buy a ship and get what seems to be a rate of return that once you lever it with a virtually zero cost of debt, you can make an exceptional rate of return. Well, what happens when banks aren't so eager to be making loans and all of a sudden their interest rate margins start to go up a little bit? It becomes a lot more challenging to get the capital in the first place, but ultimately continue to make a rate of return that is both acceptable to the owner as well as acceptable to the liner company.
Just a comment on that as well. I think I have a lot of stuff that I still want. I think if you look at the demand side of the container market, one of the issues I've been having is the slow growth in Europe. And on a TEU mile basis, Europe is obviously, though not as important in volume, it's extremely important in TEU miles. So in a way, we think that the real upside on the container market will be found first when you see a meaningful recovery in Europe, because I do know that there are a lot of people in Europe who still want lots of stuff if they can afford it.
Herman, maybe if you could just sort of take us through LPG, LNG opportunities in there. It's something that we haven't spent too much time on today.
Sure. On the LPG side, I think it's a challenging outlook on the supply side, which I think everyone knows. What really worries me as well is the growth in U.S. propane production has started to slow down. So we're fundamentally not that bullish on the LPG space, though stocks are cheap. On the LNG side, I think, at least personally, and I even bought Golar on my PA account, which wasn't a very good idea. But if Golar is able to do what they are trying to do, which effectively is to completely redefine the way the LNG structure works today, they've teamed up, as Ben alluded to, with Schlumberger, and they're effectively trying to create the full value chain from the upstream part and straight into the electricity grid or into a power plant. The problem with the LNG market today is A, cost of liquefaction cost is too high, and B, there's too many intermediaries. The first time I talked to a guy called Oscar Spiegler in Golar, he said LNG stands for long negotiating game. It takes forever to execute projects. And that's what Golar is trying to do with Schlumberger. And if they're successful in doing that by, with Schlumberger, accessing very cheap upstream gas, they will effectively have a delivered electricity price into the global electricity market of $4.1 to $4.3 cents per kilowatt hours. And to put things in perspective, in Brazil, the wholesale price is about 9 cents per kilowatt hour. In Philippines, it's 18, which means effectively if the project captures that entire value creation, then you have 1.5 to 6 year repayment of the entire infrastructure. So it's Golar to me is a company with a vision and trying to change how the dynamics are, and frankly it's required. It's required to find a way to generate liquefaction growth, because as it is now, the Australian projects aren't competitive whatsoever. They're way too high on the cost curve. Even the low-cost US projects are struggling. So Golar, I hope, is a part of a solution to the long-term prospects for the LNG market.
Ben, any thoughts on your end, on the diamonds in the rough?
Yeah, I think as opposed to the tanker space, and again, I think the tanker space should do reasonably well. But I think when you look at the underlying fundamentals of the comparing and contrasting, say, tankers to LNG or even LPG, what you have is a tanker space where you're largely dependent on OPEC to continue to really pump out oil in order for it to work, and if they don't, then oil prices come up. But if that were to happen, then obviously natural gas prices come up, more than likely LPG prices come up, and the reason, and ultimately if the prices come up, you're going to get a big influx of new volume from those. So in some ways it's inversely correlated to oil prices, and longer term, I think, because the resources are available, both in the United States and other places, your runway to growth in both LPG and LNG is much more transparent, is much more obvious, and ultimately there will be no shortage of opportunities in those areas that, for the moment, many investors are basically leaving for dead because they're looking at $28 oil or whatever it is and saying, well, clearly this is never going to work. And the reality is, I think virtually everybody in this room can agree that we're probably not sustainably in a $30 oil price environment. And so I think you have a resource base that will eventually grow. And when it does, you'll need ships to move it. And I think what investors can longer term get behind is something where, again, there's a predictable level of demand growth. Like to Herman's point earlier, one of the things that investors like to see is predictability. That increases their confidence in their investment. And longer term, to the extent that you have resource bases that will grow, there's a higher degree of longer term predictability in those categories. And I personally think over a longer investment horizon, the LPG and LNG names have a much longer runway in terms of the upside in the equities relative to most of the other categories, which admittedly everything's cheap right now. So.
Let me just say what these guys all said was completely wrong. No, I'm kidding. But basically, I mean, just thinking about LNG, I mean, I'm not the biggest LNG guy. I don't cover the sector. But it seems like it's still in the young ages, as you guys said. I mean, you can actually see the path to growth you can see how the shipping, how it's going to develop. It might be longer term. It reminds me sort of the tech sector, where when I used to cover tech, where there's sort of the hype stage and then everyone's excited and then it sort of collapses and everyone says, oh, this is horrible. And then eventually it actually does exactly what everyone thought it would do, just longer than it would take. And I think that's pretty much where we are for the LNG, LPG sector now. That's it.
So, moving to dry bulk. So, last year at this conference, I had posed a question to the panel that I had $100,000. I was prepared to be risky, and I wanted to double my money in the next 12 to 18 months. The panel basically sent me to dry bulk. Just want to report in, it didn't work out that well.
We didn't say what you were going to do. We didn't. Did you hear the short, or was it?
No, it was a long, you were telling me. Anyway, dry bulk, is it time you suggesting I double down on this year again, or what do you think? Ben, why don't you take, be nice.
Okay, well, I think something has fundamentally changed in the dry bulk space since last year, and we as analysts probably should have predicted it, and unfortunately didn't. But when you look at what moves on dry bulk, 51% of all coal that is moved is imported into China. 54% of all aluminum that is moved is imported into China. 45% of all steel is produced in China. You can't be more levered to China than the dry bulk market is. So what happens when Chinese industrial growth, or GDP, goes from 7% to what I think is probably south of 4%? It's not pretty, and that doesn't even begin to touch the supply side. I think that's the issue. It's a levered China play, and China's just not working. Eventually, we'll get to a more sustainable supply and demand balance. But given how there's a saying that used to go around that when the United States sneezes, the rest of the world catches a cold. Well, that's begun to happen in reverse. So when China sneezes, the rest of the world catches a cold. They're the 800-pound gorilla. Little moves in what's going on in China make big differences in the dry bulk space. Unfortunately, it's a lot more than a little move. It's a big move, and it's going down, and it's still going down. And unfortunately, I don't have any clarity as to when that stops, which is not especially pleasant. So, yeah.
So Onassis once said that, except that the day of the quotes, he once said that except that the sea will never rest and learn to sail in the high winds. And I fully agree with Ben that the dry market looks very rough the next couple of years. But again, the way to make money is to buy low and sell high. And people, I think, forget to remind themselves of why are things cheap. Right now, we are on a nominal 30-year low on asset prices, for a very good reason, as Ben just pointed to. And I think, if you look at dry bulk demand growth since 1975 or 1976, volume of trade has increased by 3.4%. And then you can say, well, the last 15 years, China has been 70-80% of the demand growth in the dry market. So if you then look at the period from 75 to 2001, China became a member of WTO in December 2001. If you look at volume trade up until that, it was still about 2.5 to 2.8%, whether you start in 75 or 76. 75 was a down period. So I think fundamentally, do you believe that there is a future for the dry market? When I ask myself that question, I say, yes, I do believe there is a future for the dry bulk market. When it will turn, I find that very challenging to say it will happen tomorrow or December 2017. But I know that if you can invest into the dry bulk space and sail the rough seas that we have in the next couple of years, most likely you're not going to do a very bad investment. And I think that's one of the reasons why you see a lot of the very intelligent and with a very long track record of ship owners investing into the dry bulk market. Should you buy in the dry bulk equities? No way. I mean, that's playing Russian roulette. But yeah, I think you should go and buy yourself a ship. Don't take too much debt on it, and be patient.
Thank you.
I would argue don't take any debt if you can afford to buy a ship now. But, you know, if you look at it, as you said, I mean, the guys that are buying, for better or for worse, have deep pockets. So if this lasts 6 months, a year, 2 years, 3 years, they'll be okay. It depends on what you want to do. I mean, now's the time that vessel values are insanely cheap. They could get cheaper. I mean, let's be fair. China's, you know, there's a lot of talk that China coal imports are only about 5 to 7% of the total demand for Chinese coal, let's say. But that could go to zero. I mean, it could. China, it's only about 200 million tons. They could easily, you know, environmental concerns, it could go to zero. So we have to see what's going to happen. I generally agree with Herman. I think we're back in the world where dry bulk grows at about 2 to 3% a year going forward, once China sorts itself out. But there's still a vast oversupply of vessels, and that needs to be fixed. You know, I've heard the guys earlier talking about scrapping and layups, and scrapping's better than layups, but I still argue that there's too much scrap. There's probably too much scrap steel in the world, and there's going to be more. Scrap prices are falling like crazy, so I don't understand why the scrap yards would expand to take more capacity. I just don't see it. So you're looking at 2 to 3 years at least, if you're talking scrapping, to get back to a more balanced market.
But just a follow-up as well. I think Ben said something very smart earlier on.
Impossible.
But I think it's the question you also have to ask yourself is dry bulk the right place to put your money now? Are you getting a better risk reward in other sectors? Should you be buying a ship? I find it amazing that that ship owners today go and buy a tanker in the second-hand market, when you can buy, for example, DHT, which is effectively pricing in $58 million for a 5-year-old Cape, 26% lower asset prices. It's fully financed, all the vessels on the water. Why on earth do you go and buy a ship? Everything is taken care of for you. You just have to push the buy button and sit and wait, rather than you know, doing all the paperwork with shipbrokers. And I probably shouldn't say that, being from a shipbroker firm.
Careful.
But it do puzzles me that there are second-hand transactions when the stocks are so cheap from very healthy companies, and you do also have the liquidity to just sell the shares in one day if you want to, rather than having 15 guys inspect the vessel and so on.
Well, Herman, it's not nearly as cool to be a stock owner as it is to be a ship owner, so I think that has a lot to do with that.
Well, look, guys, this has been an excellent discussion. Thank you very much. We're up against time, but maybe we'll just see if there's a couple quick questions from the audience. This is it. I got a lot of good advice last year. This is your chance.
Maybe the question is, can we have a drink?
Nick, please.
Could I point out I wasn't here last year? I wasn't an analyst last year, so I don't get blamed.
I can ask one. It's a self-serving question in a way. What can we do to get investors, if it can be done, interested in shipping again? At the end of the day, you have listed companies there. They have a shareholder base. It's a big universe of investors. I mean, is there something we can do to generate interest, or is it?
Yeah, I think it's again, I think that if there's things that could be catalysts, either for specific companies or for the space, that's probably how you're going to get more attention, and that's what's really lacking is attention and conviction. The only thing that I can think of, and there's probably a lot of other things that I can't think of, but I think that if there were to be some M&A, some consolidation, you get people's attention and you get people guessing who's the next takeout candidate. The problem is that everyone's trading so cheaply that nobody wants to give up their equity in order to do a deal, and the only way that you could possibly get something done is a NAV for NAV trade, and still that is much easier said than done. But I'd have had a number of investors who are already long, let's say the tanker space, tell me, why can't John Frederickson just buy DHT? That would just solve all my problems. And I think to some extent that's right. I think if you can do something that generates focus on the industry, then people will focus on the values. But I'll leave that to the bankers. So.
You know, this sounds very crazy, but actually somehow, first of all, I know I'm going to be in the shipping industry hopefully for the rest of my life. And somehow I take a morbid pleasure of what's going on right now, because you have the effect of no ordering activity means that whatever OPEC decision will be or whatever will happen on the demand side, the market will be better in the long term. And the longer it takes for the market to recover, the more will the yard struggle, the more will the bank struggle, and the more hopefully disciplined will the recovery be next time around. So I think thinking about what's going on long term, it's actually not so bad what's going on right now. I don't think we need to kind of try to fight against the storm and say that shipping is a healthy industry and you should be buying tankers. The sentiment will turn when it will turn. The only thing you can do, the only advice I would give is focus on your business, focus on developing your business, on having a healthy balance sheet, on saying a clear message and diversify your company and so on. And when the investors come and knock on your door, you're prepared, and there's no reason to not buy your company because you've prepared. That's yeah.
No, I think, Herman hit on it. I think it just takes a little bit of time because sentiment is horrible right now. Sentiment will come back. They need the world to calm down first. They need to see that oil prices calm down. They need to see that the market calms down. And then slowly but surely people will start looking, and you'll start looking, hey, what's cheap? Oh, maybe tankers are cheap now. Let's see where we are. But I mean, the problem, part of the problem as well, you talk to buy-side guys and they'll tell you that they think the markets are broken. Everything's, high frequency. I have a friend of mine that actually sells software that scans press releases for keywords and then trades off that. So they don't even have to read press releases anymore. That's why you see guys like Ardmore that are down 20% because they missed earnings by 2 cents, especially for low liquidity stocks, which unfortunately all shipping companies are. It's a volatile world right now. So people are a bit skeptical about what's going to happen, and they'd rather just avoid it. But in time, they'll come back. As Ben said, I think M&A would push that. And everyone, guys I know, the same thing. They own Generate. I'm not selling because eventually they'll get taken out, and then I'm set. Hopefully, maybe Chaco should think about them, but I'm kidding. I'm not a banker. But they need something to make them look back at the sector. Everyone likes dry. Everyone looks at dry now, but everyone says we got time. There's no reason to go near it. And tankers, there's not really anything that looks so positive. It might stay strong, but there's nothing urgent to make them invest today.
Just kind of want to follow up on that as well. I think be humble to what the market is telling you. And right now, people are seeking liquidity. Yeah. Maybe ship owners should think, do I have the right structure? Is it correct to be a 15-ship, $200 million market cap? Is that what the investors really want? Well, maybe not. Maybe it's better with long-term as well to have a larger fleet, larger market cap in terms of being able to access long-term chart contracts or good bank financing and so on. That's what I would have at least be thinking to myself if I were a ship owner.
Well, I think you have one.
No, that's okay.
Okay. Well, Herman, Ben, Robert, thank you very much for an excellent discussion. Nick, congratulations on a wonderful conference today. And I think we're off to the cocktail hour now.